And good afternoon. Another hot day in Houston. What else is new? We are the Price Group, and welcome to our continuing series on monthly updates. Our goal here is to give you some information in sort of bite-sized pieces to the point and make good use of your time for perspective on what's going on in the financial markets. So welcome. I'm Randy Price. He's Matt Price. We're a family-owned and operated group here. Over 45 years of experience. We are a fiduciary, and as many of you know, the majority of our clients are either retiring or already retired.
And most clients on the phone probably seen this slide before. Randy and I both certified financial planners. Randy's too humble, so we'll brag on his behalf. Been recognized by Barron's, Forbes, Financial Times. If you followed us for any length, you've probably seen our Wealth Coach podcast, our weekly Retirement Insider emails. And so we think education is important. We think that for ourselves, but also keeping clients educated on topics at hand. A little bit about our firm, Steward Partners, based off the biblical definition of stewardship. Raymond James is one of our custodial options. That means that's where our clients have their dollars held. We do have a few other options, but Raymond James has been a great partner thus far, and we don't really have a recommendation for clients to change at this point, or we don't think going forward.
Might mention also, Steward Partners just celebrated their 10-year anniversary. So anyway, happy birthday, Steward Partners. We're glad to be here. Let's take a look into some of the information here. Look into what we call the consumer health. What's going on good, what's going on bad as far as the consumer is concerned. The good is that consumer wage growth is above her historical standards. You've got debt service historically low. On the other side, credit card debt is going up, and you can read along there. The consumer accounts for about 2/3 of the economy. The consumer is strong sort of in the big picture, but is being stretched a little bit with inflation and things costing more. Not anywhere near like 2008, where the consumer was way over levered. It looks like the consumer has a little bit learned some of their lessons, and it doesn't hurt that you're getting a little bit on your savings rate now. One of the most often asked questions we get is that R word, the recession. Recession. The bad thing about a recession, it sounds like a depression, but remember, a recession can be sort of mild or it can be severe. We think possibly that a recession, as defined by 2 straight quarters where the economy shrinks, could happen at the end of this year, the beginning of the next year. But we don't think it's a deep recession. We think it's a mild recession. In a mild recession, unless you read about it or somebody told you about it, you might not even know that there was a recession happening. So don't be scared by the recession word. But the Fed is trying to slow the economy down by some higher interest rates.
Here's what Randy and I spend probably half of our day talking about Mondays through Fridays, and that's inflation and interest rates. That's what's on everyone's mind. It's all in the Wall Street Journal. You click on the TV, it's what they're talking about there as well. Here later this week, I think it's on Wednesday, we're going to get the June 2023 CPI, or Consumer Price Index, one of the measures for inflation. And our expectation is that we should see inflation move close to 3%. And our basis for that would be they are going to have the June of 22, so last year's June, fall off, which was a really big number, above 1%. And so assuming that June of 23 is pretty close to May of 23, you replace it with a more muted number, and you should see that inflation rate, which they're measuring around 4%. You could see it, like I said, drop close to 3%, which would be a huge move. So that's part of the reason you've seen the equity markets do well. here as of late. With that being said, what most people are expecting, and Randy and I would agree, we should see at least one, maybe two more interest rate increases from Mr. Powell, the Federal Reserve. If you look back at history, the Federal Reserve, it's kind of like the pendulum. It sometimes swings too far in either direction. Historically, they have overdone it when it comes to raising interest rates. That would be our thought. We think that rates have moved high enough to deter economic expansion to the point where inflation can be squashed, but they haven't called Randy nor myself and asked for our opinion yet. The job market still looks really healthy. That's one of the things you'll hear Mr. Powell talk a whole lot about. He wants there to be more unemployment, which is, you could say is counterintuitive, but that typically means a slowing economy has happened. And we think overall, we think bonds are a really interesting place to hang out, to be getting more than 3+%, even on tax-free bonds, depending on the type of bond. We think it's a good ballast to the ship. And coming off a bad 2022, like we had last year for most all bonds or fixed income, we think it is a good alternative to stocks to reduce some of the overall risk in the portfolio.
One more thing before we leave that slide, Matt. It's interesting, at least from sort of our point of view, being a little bit geekish, but the 1-year Treasury today is about 5.4%. The 30-year Treasury is right at 4%. So what the market is saying is just what you said, is we don't expect short-term rates to stay this high, and therefore we have what's called an inverted yield curve, the short-term rates being higher than the long-term rates. If you look at being an income-oriented investor, and again, we've talked about many times the need for an investment process, but we love dividend stocks because dividend stocks are good during a recession. Dividend stocks are good during a period of inflation. And it's really amazing the contribution to total return that the dividend makes over time. And you can see the various decades there of the 40s, 50s, 60s, so on and so forth, where the dividend contribution to total return is measured in the blue. And what if going forward here that stock returns are more muted, and you have a dividend yield of 2 to 3% when you're getting 6 to 8%? Well, that dividend contribution could be even more than it's been so far in the 2020s at 23%. So we love dividend stocks. One of the most often asked questions is, well, look into your crystal ball and tell us what's going to happen in the second part of the year. We just finished, obviously, the first half of 2023. Hard to believe. Between now and the end of the year, we're not expecting things to really go crazy on the upside, and we're not predicting a big drop whatsoever. The big performance by the S&P 500 largest stocks for the first 6 months of the year was basically driven by several of the large technology stocks. For example, Apple stock was up almost 50% for the first 6 months of the year. So again, dividend stocks, and we think dividends will continue to be a big portion of the total return that you get from investing in stocks.
So those were our prepared remarks. We'll flip through our disclosures here, and let me stop sharing my screen. I'll pull up some questions for us. Got a few questions here, Randy. Talking about just cash in general. Is cash now a good investment? How about you take that one?
Well, cash is certainly not trash anymore. The Federal Reserve, in raising interest rates to combat inflation, to slow the economy down, the Federal Reserve has made it more costly to get a credit card. But on the other side, if you have cash and the bank is not paying you anything, well, then there are options available. All of these large money center banks, even the large brokerage firms, Raymond James, Merrill Lynch, et cetera, they make a lot of money by not paying the client very much on their cash balances. What we've done here at Steward Partners, which serving as a fiduciaries, we've gone around Raymond James, and rather than getting 0.1, 0.2% on your interest, we're using an institutional money market that would normally be a $10 million minimum. And I think the last time I looked, it was a 5.1, 5.2. So that's been one of the bright spots during some of the Fed's move, is clients are getting substantially higher interest rate on their money market. So it's not an investment, but it's a good place to park cash. And as we talked about, at some point, if short-term rates go down, you're going to wish you own some longer maturities. That could be some CDs at 2-year, 3-year, 4-year, 5-year, or it could be some longer-term bond mutual funds, as we're using both of the aforementioned.
Good answer. And the second question was rather similar, so you did a good job answering both of them. So those were all our prepared remarks. Any questions offline, please email Randy, myself, give us a call, and we'll see you. It is July next month. We're going to have our bigger quarterly presentation that's going to be more robust, have 20 to 30 slides or so in that prepared for our clients. So any questions in the meantime, let us know, and y'all stay cool.
Thank you.